The Bank of Japan intervenes to stop the collapsing yen. Jerome Powell is waiting for you to lose your job. Everyone in crypto seems to be getting arrested, and despite all of that, Bitcoin is holding strong at around $60,000. We'll discuss all that and more in today's episode. The Japanese yen, which is down 10% against the US dollar over the past year and 27% in the past 5 years, fell hastily upon market open on Monday, prompting the Bank of Japan to intervene. Twice this week, the yen spiked against the dollar as the BOJ purchased yen in an attempt to slow down the bleed. According to reports from Bloomberg and the Financial Times, the BOJ spent nearly $60 billion across 2 moments of intervention. I'm careful to use the phrase slow the bleed rather than stop the bleed. With Japan's debt to GDP ratio north of 200%, inflation has no doubt been a policy choice. A devaluing currency makes it easier to pay back their debt as more units of currency circulating through the system allows nominal GDP to rise, ultimately leading to a nominal increase in tax revenue. Since 2011, the yen is down 50% against the dollar, and during the same period, the dollar is down 99.99% against Bitcoin. The central bank playbook of debase the currency to ease the debt burdens is being executed in the United States just as it has been in Japan. We're just a few years behind in the process. On Wednesday, the Federal Reserve convened and expectedly left the federal funds rate unchanged. While the arbitrary level of 2% is the Fed's target inflation rate, their eyes and policy decisions have clearly shifted towards the employment market, which esoterically concedes that 3% is the new target inflation rate. In his press conference, Jerome Powell essentially declared that he won't begin cutting rates until unemployment becomes an issue. To quote Powell, "We are prepared to maintain the current target range for the federal funds rate for as long as appropriate. We are also prepared to respond to an unexpected weakening in the labor market." The Treasury market certainly isn't expecting cuts anytime soon. Both the 3 month and 6 month Treasuries have yields higher than the effective federal funds rate. If these market participants expected Fed funds to go down during the coming months, there would be more demand for those Treasuries, buyers would step in, and yields would drop. Speaking of treasuries, the U.S. Department of the Treasury announced this week that they will buy $2 billion worth of off the run securities each week in order to provide liquidity support. For those unfamiliar, off the run securities are treasuries that were sold at previous auctions, whereas on the run securities refer to the most newly issued securities. The velocity at which the Fed hiked rates in 2022 caused many long duration off the run securities to go underwater due to the on the run securities having higher yields. If you recall, the banking crisis of 2023 stemmed from banking institutions being forced to sell off the run securities at a loss. It appears that the Treasury is concerned with the state of the bond market. I would be concerned too if I were the US Treasury, considering they are already $34 trillion in debt and they're having to borrow more at higher interest rates in order to finance government spending, as well as payments on the outstanding debt. Long duration bonds responded well to both the FOMC meeting and the buyback announcement. TLT, the long Treasury bond ETF, is up roughly 1% since the market opened on Wednesday. However, zoomed out, things look far more bleak, with TLT being down nearly 10% year to date, 14.5% year over year, and 27% over the past 5 years. MicroStrategy hosted its fourth annual Bitcoin for Corporations event. Michael Saylor, founder and executive chairman, announced MicroStrategy Orange, an open source Bitcoin inscription method that allows users to store and manage decentralized identifications using UTXOs on chain. Saylor has spoken extensively about the potential for Bitcoin to reduce online spam and provide verification of identity in a way that allows one to remain in control of their own data, which may become increasingly necessary in a world in which AI deepfakes are running rampant. MicroStrategy cited a plethora of potential use cases for DIDs, and it will be interesting to see if, when, and how institutions and individuals utilize this. In what seems like a continuation of a crackdown from US federal law enforcement on Bitcoin and the broader crypto market, CZ, the founder of Binance, was sentenced to 4 months in prison on charges of enabling money laundering. Roger Ver, who is most widely known for being on the wrong side of the block size war, was arrested on far more serious charges of tax evasion. According to the Department of Justice, Ver evaded roughly $48 million in taxes. Ver, who revoked his U.S. citizenship in 2014, is facing up to 20 years in prison if he is convicted. Jack Dorsey announced that Block, formerly known as Square, will be dollar cost averaging into Bitcoin every month. Along with this announcement, they released a blueprint for other corporations to add Bitcoin to their balance sheets as well. With the FASB rule change coming into effect at the end of this year, it's likely that many more corporations will begin building a Bitcoin position on their balance sheets, now that they will no longer be unjustly penalized from an accounting perspective for doing so. After 7 consecutive months of up-only price action, Bitcoin closed April with a red candle. In the grand scheme of things, this pullback is nothing short of a typical bull market correction. Risk assets across the board have been going down during the same period. Moreover, considering the plethora of seemingly negative headlines that have surfaced over the past couple of weeks, Bitcoin has held up well, far better than what the bearish sentiment online might lead one to believe. Bitcoin has found support at around $58,000, which happens to be the aggregate cost basis of short term holders. Short term holders being those that have moved their Bitcoin within the past roughly 155 days. This has been a key support level in past bull markets, and it's already provided support 3 times in the past 18 months. Even if you view Bitcoin on a short time frame, as long as this level holds, there's no reason to turn into a bear. However, it is still best to approach Bitcoin with a long time frame, 4 years at a minimum. Notably, the spot ETFs have posted 2 consecutive weeks of net outflows. As it turns out, many of the so called institutional investors that are getting their exposure through the ETF suffer from the same emotional reflexivity that is stereotypical of retail investors, fearfully exiting their position during short term price dips. On a more positive note, a suite of Bitcoin ETFs launched in Hong Kong this week, attracting roughly 292 million in assets on day one. The winner of the bunch was the China AMC Bitcoin ETF, which garnered roughly $123 million worth of assets on day one. It's no secret that right now is a trying time for Bitcoin miners. With the block subsidy now at 3.125 Bitcoin per block, Bitcoin miners are being put to the test. This level of ruthless free market competition is not present in any other industry. Miners will survive if they can 1. Source low cost power, or 2. Acquire efficient ASICs. Miners that can't accomplish this are not operating profitably, and there's no subsidies or government intervention that can change that. However, the medium to long term outlook is not bleak. The capitulation of the weakest miners on the network will decrease sell pressure on Bitcoin, ultimately leading to an increase in price. Miners that have acquired efficient ASICs will be able to hold out until the bull market resumes and hash price rips to cycle highs. As mentioned, miners with low cost power and efficient ASICs are still operating at a profit. The next projected difficulty adjustment is negative 2.7%. So while difficulty may be dropping, it's only marginal, which tells us that a majority of miners on the network are still profitable in the current environment, and highly profitable at that depending on the machine type. For example, an S21 mining at Blockware's facility with a 7.8 cent per kilowatt hour electricity rate can mine 1 Bitcoin for roughly $42,000 worth of electricity, compared to the current market price of Bitcoin, which is around $60,000. With Blockware's turnkey hash rate marketplace, you can purchase an S21 that is online right now. The only thing better than buying the dip is mining the dip. Click the link in the description below to get started mining today.